On February 4th, the silver market sent a signal that most people misunderstood. After a brutal sell-off that erased weeks of gains and forced traders out at the worst possible moment, silver didn't stabilize. It snapped back violently. Prices surged fast enough to shock traders and confuse commentators, triggering headlines that asked the wrong question. Everyone wanted to know if the worst was over. Almost no one stopped to ask why the move happened this way. Before we go any further, if this kind of breakdown matters to you, hit like and subscribe, because what you're about to see doesn't get explained honestly anywhere else. What most people saw was a rebound. What actually happened was a stress response. Violent moves like this don't appear in healthy markets. They show up when leverage collapses, pressure breaks, and positioning changes hands under extreme conditions. And when that happens, the real story isn't found on charts. It's found in who was forced out, who stayed flexible, and who quietly absorbed the damage. The crash leading into this rebound wasn't gradual. It was mechanical. Margin pressure increased, liquidity thinned, and traders were pushed into selling whether they wanted to or not. In environments like that, markets don't reward conviction. They reward balance sheets. Smaller participants scramble. Larger institutions wait. And this is where structure matters. As price rebounded, attention stayed locked on charts, while something more important sat beneath the surface. Reports surfaced that one of the largest institutions in the silver market was carrying massive unrealized losses tied to derivatives exposure. JPMorgan, not because of rumors, but because of scale, history, and documented positioning. This isn't about accusing anyone of causing a crash. It's about understanding how large institutions experience volatility differently. They don't react emotionally. They manage exposure across cycles. When markets fracture, they don't panic. They reposition. That distinction explains why the rebound arrived before confidence returned. It arrived while fear was still fresh. That's not random. That's what resets look like when leverage is flushed and control quietly shifts. If this were just a temporary bounce, pressure would have eased, physical demand would have cooled, stress indicators would have relaxed. Instead, tightness remains, volatility hasn't disappeared, it's moved, and when volatility shifts instead of fading, it tells you the system hasn't healed. It's adjusting. Focusing only on charts right now is dangerous. Charts show where price has been. They don't show who was forced to sell and who had the flexibility to wait. That information lives in exposure data, delivery behavior, and institutional positioning. JPMorgan's reported losses matter not because of the headline number, but because of what they signal. Losses of that scale don't surface during calm periods. They appear when stress reaches deeper layers of the system, and this matters far beyond silver. Moves like this don't stay contained on charts. They ripple into savings, pensions, and purchasing power. Silver isn't just another asset, it's a pressure gauge. When that gauge behaves erratically, it rarely points to an isolated problem. Silver sits at the intersection of money, industry, and leverage. It's used in manufacturing and energy, but it's also heavily traded through paper contracts. That combination makes it extremely sensitive when liquidity tightens or leverage breaks, and when markets reset this way, losses don't land evenly. Institutions with deep balance sheets can absorb volatility and wait. Households can't. Forced selling doesn't just close positions, it locks in losses. And once that happens, recovery becomes much harder. We've seen this pattern before. In past cycles, silver didn't fail quietly, it broke violently. Sharp advances were followed by brutal collapses that convinced most participants the story was over. Confidence vanished, and once forced selling was exhausted, the market reset and moved again in ways few expected. This sequence repeats because it's structural. Leverage builds during rising prices, liquidity tightens, margin pressure increases, weak positions are forced out, selling becomes mechanical. Once enough leverage is removed, pressure shifts. What makes the current situation more dangerous is scale. Today's silver market is far more financialized. Paper contracts dwarf physical supply. Derivatives amplify exposure. Global demand is broader and more persistent. When stress hits, the system doesn't absorb it smoothly. It fractures. That fracture reveals who has flexibility and who doesn't. Retail participants face margin pressure. Institutions don't face the same constraints. They can wait while the market clears weaker positions. That imbalance isn't accidental, it's structural. This is why JPMorgan's role draws attention, not because it controls markets, but because its size places it at the center of stress events. When silver breaks violently, it's often because leverage built elsewhere snaps, and that snap ripples outward. An unrealized loss doesn't mean failure, it means exposure. Large institutions hedge, offset, and restructure risk in ways unavailable to others. They don't face the same urgency. That's why losses at the top and liquidations at the bottom often happen at the same time. Risk transfers from those who must act to those who can wait. History supports this. Silver has behaved this way before. late 1970s, financial crises. Each time, violent collapses preceded repricing once leverage cleared. Physical demand didn't disappear, it waited. And that brings us to the data. If this were just noise, the numbers would confirm it. Instead, open interest collapsed. That doesn't happen when long-term holders lose faith. It happens when leveraged positions are forced out. At the same time, physical silver didn't flood the market. Availability didn't improve meaningfully. That divergence between paper and physical is critical. One side must adjust. Backwardation appeared. Inventories stayed tight. Global demand remained intact. These aren't signals of failure. They're signals of imbalance. Put together, the pattern is clear. This wasn't a failure of demand. It was a failure of leverage. And leverage failures don't end stories. They reset them. After resets, markets don't become safer. They become sharper. Smaller imbalances move price faster. Volatility reorganizes instead of disappearing. That's why the next phase matters. From here, there are two paths. Either supply loosens and pressure eases temporarily, or demand continues to outpace availability and price reacts violently again. Both outcomes involve sensitivity. Neither involves calm. What's dangerous now is confidence. Rebounds after liquidations often create false security. They happen before stability returns, not after. Experienced observers understand this. They're not debating direction. They're watching vulnerability. Thin markets don't need headlines. They move on imbalance alone. This is where preparation matters more than prediction. You don't need perfect timing. You need awareness. Awareness of how leverage breaks. Awareness of how physical demand behaves under stress. Awareness that violent moves usually come after excess is removed, not before. What we've seen isn't a conclusion. It's a transition. And if this video helped you see the silver market more clearly, like this video. And subscribe to the channel because this cycle isn't finished, and the next moves will matter even more. Stay sharp, stay informed, and make sure you're watching before the next shift arrives.